Good morning and welcome this morning to Trader Talks. In today's market, there was the opening bell still ringing in my ears. That means it is time to get started here this morning. And I am joined this morning, excited to be joined this morning by my good friend Brent Morris, who is a 20 plus year veteran of the financial markets. He is a phenomenal educator and commentator and coach. And we are joined out there in the chat by our good friend Barb Armstrong, who is also a 20 plus year veteran with brand new knees. She's Canadian, but we're not going to hold that against her today. So we're glad to have her out there in the chat helping us out and taking care of those chat comments. Thanks to all of you for being here and participating in the conversation. If you're watching this in the recorded version, leave us some comments in the comment section. We'll reply to those as well. Brent, it is an interesting morning this morning as we get started. There's a lot of stuff going on, but how are you doing this morning?
I'm doing good. And you know what, Ben, I was thinking, we've been working together for over 20 years now, I think.
We have been.
Am I
we
correct
have
on
been.
that? So yeah,
Yes.
we've seen a lot, and it's a pleasure to be on with you. And you know, I know a lot of those out there know you from the workshops you go around the country and teach. And if you haven't hit one of those up, folks, I encourage you to do that. And you know, a lot of people don't know your other talents, including you're a thespian there as well.
Just finished up a little while ago a run in Annie in community theater. So, you know, I was not Annie this time,
Okay.
but I was FDR. So, hey, Brett, it is great to have you here. Hey, couple of quick housekeeping items, though, before we get into the meat of this discussion. And you're right, we have been doing this a long time. And so we know this, but we want you to know this stuff as well. Remember that everything we talk about simply for illustrative and educational purposes only. None of this is a recommendation or advice about a particular security or strategy. If we do happen to talk about options today in this discussion, remember that options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of and you understand the characteristics and risks of standardized options before considering any option transaction. We're going to be using the Thinkorswim desktop software platform today, specifically the paper money version of that platform. It's not a guarantee of future success out there in the real world. It does some things differently than a live trading account, but it's a great sandbox to play in and practice. Remember that technical analysis, which is one of the ways that we're going to look at the market today, is not the only way to look at the market. All of the ways that you might look at the market are theoretical at best. None of those are guarantees as to what's going to happen. That's a dynamic environment in which we live and work and play and look at the market. So things can and do change because past performance is no guarantee of future results. And investing involves risk, including the loss of principal. So Brent, let's pop over here and let's take a look at what's going on in the first part of the discussion here. Generally, we take a look at what's going on in the markets as a whole. So I've got the three major indexes up here. I've got the SPX, the NDX, and the Russell 2000 that we can just go through in turn. And then we'll kind of roll through some of the other factors going on here in the market this morning, and then maybe get to one of the things that's on everybody's lips and mind and fingertips as they post about it and tweet about it and all those things. And that's NVIDIA earnings coming up later today.
Yeah, well, let's start with SPX here, Ben. You know, because when I look at the market, generally that's kind of my go-to in terms of what to look at first. And we are not far from an all-time high on SPX. And so it's the same old story because we've seen this a bunch over the last few months. And, you know, we just need a moderately up day, to be honest. And we would see an all-time high because we hit one about 3 days ago, I think. But the trend has been going up. You know, we had that pullback a few days ago, but, you know, we were telling everybody, hey, look, the pullbacks are normal. We've seen this. If you just look back at the past, you see a pullback and the trend is going. So the trend hasn't been violated. And I see we can look at that RSI at the bottom and we can talk about a potential divergence on that. But I'll tell you what, if you're a trend trader, the trend is going strong still, Ben.
It is a love story for sure, Brent. Now, you know I was going to use Taylor Swift song titles today, right? I mean, come on, you have to. But August is slipping away like a bottle of wine for sure. And so we're getting down to this the end of the month here. And again, as we get into some maybe rebalancing at the end of the month, we're still seeing some momentum to the upside. A couple of big green up days here in the last 3 or 4, but maybe you're right, that little bit of a slip to the downside in terms of the RSI, and a little bit of a gap up. Actually, maybe a little bit of a gap down and a bit of a rally here this morning if we kind of stretch these candles out a little bit and take a look at them. A little bit of a gap down and rally, but it's thin this morning so far. And I think that may be the story of the day here is the fact that maybe we see a little bit of thin trading, a little bit of wait and see mode going on until we get some clarity about the bellwether that NVIDIA really truly is in this case, or at least the market is viewing it as such. So as we
one thing I'll say on that, Ben, is NVIDIA. So S&P, I think a lot of you know out there, the S&P 500 is a market cap weighted index.
Yep.
And so NVIDIA's earnings are after the bell here today. So, what I think what you're saying is, if we're kind of waiting for that, we may not see huge moves before that, and then we may see a bigger move in the morning. But the NVIDIA is about over 7.5% market cap weighting on the S&P 500. That's, think about that, folks. There's 500 stocks on the S&P 500. 10 of those stocks represent, I think it's 40% of the overall index movement and market cap and potential movement, with the NVIDIA being the most significant of those. So it's not like, there's 500 stocks, one is going to move the market a little bit, one may move the market just a smidge. This actually has potential to move the market a lot.
For sure. Yeah, it does. And the reason that those stocks are sometimes referred to as, like the Mag 7 or the Big 10 or whatever the media pundits, use to refer to those that are the heavyweights within this index, is because they are the heavyweights within this index. And when they do move, they do tend to move the market, to your point here, Brent. And, we can also look at that as a component of the NASDAQ as well, because again, Tesla or NVIDIA is going to sit within the NASDAQ, and as a component of the NASDAQ 100, it's even a larger weighting, right?
Yeah, it's about 14% of the NASDAQ 100. So that's huge. And so, that probably makes sense. The NASDAQ, when you think of NASDAQ, most people think tech, right? It's not all tech.
Right.
But it's heavily weighted. It's about half tech or something like that. And the biggest tech stock out there is NASDAQ. The biggest stock in the world, not NASDAQ, is NVIDIA. And it's likely to play an even bigger impact on the NASDAQ movement here.
So the NASDAQ 100 right now, kind of again sitting neutral, a little bit further away from that all-time high that we saw on the SPX. So not kind of banging up against that. But again, that's a function perhaps of a little bit of this wait and see and some uncertainty that we've seen in the technology space, some rebalancing in the technology space. Certainly we've seen the AI leaders, we've seen the chip space moving, the virtual currency space moving. So there's been a lot of maybe a little bit more volatility here within the NASDAQ. As a matter of fact, if I were to pop volatility onto this chart here really quickly as well, let's see if we can do that. IMP implied volatility. We'll just take a look at the volatility of this particular chart. It's not huge, but neither is it zero, right? So the volatility has moved around a little bit in terms of the NASDAQ, whereas if we were to look at, something else, probably not as much in terms of that volatility or that expected potential movement. And then the one that really, Brent, and as I looked at this yesterday when I was talking about and teaching about long options trades, was the move that I was seeing on the Russell 2000. Now, this is one of those things where you kind of have to sing the Sesame Street song. One of these things is not like the other. One of these things just isn't the same, because the Russell has been moving a little bit differently, uniquely to the other two indexes in this mix, hasn't it?
Absolutely, it has. And so we're not looking at, the breakout right here isn't an all-time high or anything like that. And the NASDAQ, for the most part, has underperformed over like for the last few years, I'd say, actually, Ben.
Right.
But over since the April lows, we've had a nice run up. We still have had a trend, and that's good. And when you talk about the Russell 2000, we're talking about small caps here.
Yeah.
And small caps of all the indexes are probably going to be the ones that are most invested in interest rate. So, in what the interest rate's going to do is going to be most impactful on that. And most concerned with recession. For a while, we had a discussion, for the last few months. It was like, well, hey, what are the odds of a recession? And
Right.
the odds we'd say, well, odds are pretty high. Well, that talk is kind of diminished here at this point. We're not hearing that much anymore. Still concerns about, we don't know where interest rates are going necessarily. We don't know exactly what the economy is going to do, but less talk of recession. And that has probably boosted the rut lately. And we're seeing that. And so it's had a nice, for a while, it was like just woefully underperforming. Not so much anymore.
Right. And you're exactly right. I mean, talk about, again, a little bit more volatility coming in here to play, after that August low, and right coincident to the ominous golden cross, Brent. That's the 50-period moving average, moving from below to above the 200-period moving average, which oftentimes happens late after the rally has been taking place for a while. Oftentimes can be an indication that maybe some momentum is slowing down. It really hasn't slowed down since then. So this is one of those cases where the golden cross has in fact resulted in, or been coincident to, the continuation of the run here. And we saw this big green candle on Friday, which came on the heels of Fed Chairman Jay Powell's conversation at the Jackson Hole Symposium, which is essentially their August meeting, giving some potential insight. And I got to obviously couch this in those possibilities, because it's not set in stone for sure, but that possibility of opening the door for a rate cut in the September meeting. And like you said, Brent, that's going to benefit, theoretically, according to modern theory, the small caps more so than other segments of the market. So we got that big move. Now that's kind of being digested. We're seeing a little bit more of a move today, in fact, than we are seeing on the other two indexes, a little bit larger percentage move, up 0.26% on the day, up 0.26 or down 0.26 on the NASDAQ, and up just 0.1% or even on the SPX. So pretty good day on the small caps today, kind of blasting forward and taking charge here and leading out. So that kind of shapes maybe the perspective. This is maybe, X the NVIDIA stuff, people rotating into small caps in this particular case.
Yeah, so I think the overall narrative is, unless we're seeing, something to the contrary, the trend continues. That's the trend trading perspective. Now, that's not the only way to look at the market, but the trend trading perspective is, until you prove me otherwise, or until there's enough news to the contrary to change things, there's an inertia with the trend, and that's what we've been seeing.
For sure. Yeah, trends, the idea, and we teach this, and we have kind of lived by this, is the idea that trends continue until the end of the trend. And we teach classes. I know Barb teaches a class on price patterns. She's in the middle of her Getting Started with Technical Analysis series of teaching price patterns. I happened to do chat for her yesterday in identifying reversal patterns. Got a great question yesterday, Brent, on that, is what's the difference between a single V top or V bottom and a double top or a double bottom, and I kind of came back with a cheeky reply in the chat that it's one more top or bottom than a single top or bottom, and one less than a triple top or bottom. And the answer to that is really true. I mean, when we see trends change, it's a matter of learning how to identify that occurrence and understanding what it is that you're looking for. And Barb did a great job of blowing me off as far as my comments are concerned, which is great. Good, she's good.
She's a great instructor. And for those of you who 100%. Haven't checked out that class, make sure you check out that class. Goes through a lot of the basics of technical analysis and learning chart patterns and stuff like that.
For sure. So taking a look here at the VIX, this is the volatility index. As we mentioned volatility of the market, we talked about the fact that the NASDAQ a little bit more volatile than the SPX. This particular index, the VIX as an index, is a measurement of implied volatility, or really supply and demand for options on the S&P 500. And it's one of those scenarios here where, Brent, we've had more of these recently, where we have an up day so far in the market slightly, and we have an up VIX, right? VIX up a little bit, market up a little bit, which is an interesting perspective. Normally it goes the other way. VIX goes up when the market goes down, right?
Yeah, absolutely. And so generally that's the idea is, if the markets are going up, people are feeling better about the markets.
Right.
Their anxiety is a little bit lower, their concerns, less feeling of having to buy puts or buy options to protect themselves or take advantage of bigger moves. So the VIX goes down in that case. But I wouldn't read too much into it. I mean, we're still at, what are we at? About right around 15 on the VIX here.
Right. It's still a very low VIX.
Yep.
We're still in the middle of, end of summer here, as Taylor reminds us that August is slipping away and the end of summer. But, here's one thing to think about, perhaps. And this may be, I think, an interesting occurrence of this scenario happening, where the market is up and the VIX is up at the same time. Remember, the VIX is driven by option prices, not just by put option prices, but when call option prices become more expensive as well, that can lift the VIX also. So if there's speculation, if you think about what institutional traders might do, what traders that trade index options might do, they might look at kind of the halo surrounding and that weighting component of NVIDIA, stock like NVIDIA, and its halo stocks like AMD and TSM and others within that space, and look at speculating by buying calls, because there's an equal chance perhaps at this point that the price of the stock could go up as much as it could go down. And so that can drive the VIX higher even on an up day, is that bullish speculation as well. You get that call skew driving the VIX just as much as you get the put skew driving the VIX in this particular case. What do you think?
Yeah, and just a reminder on the VIX, whatever moves it makes, it tends to be pretty fleeting. It tends to be mean reverting. So if we do get a spike, and I'm not sure I'd call this a huge spike yet, but if we do go up, it's likely to come back down. And you just if you ever forget that, just look at the longer term chart of the VIX, and you'll see spikes along the way. But it kind of always seems to revert back. Now, that's not a prediction of exactly what the future is going to be on this. And there's some uncertainty with NVIDIA earning. Maybe if NVIDIA earnings comes out and it's maybe it's a non-event, likely to see a drop back in the VIX a little bit there on that.
Yeah, and it does seem, we are in that period where it does seem to kind of be grinding. So, maybe not an expectation of a big move to the downside in the VIX, but this is also a situation where you might say, a little bit like the old horror movies, it's quiet out there, too quiet, because the VIX has been settling down along this 15 level for some time. And with news, because news can come at any particular time, as Monty Python reminds us, no one expects the Spanish Inquisition, Brent. And so some news could come out of somewhere and spike the VIX pretty quickly. So something to keep in mind with this, yeah?
Yeah, no doubt. And that's a great point, a broader point you bring up too, Ben, and that is the news that's most likely to affect the market in a big way is news that we don't know, that you
Yeah.
wouldn't have predicted. Did anybody predict, I didn't know COVID was coming. That had a huge impact on the market. I didn't know the financial crisis and the housing crisis of 2008 was coming. That wasn't anybody was predicting as news. And so, kind of the bigger things that affect the market are often things that are just kind of way out there that we don't even, that aren't on anybody's radar. I mean, we can look at NVIDIA earnings, we can look at tariffs and others. Those we can kind of price in, or recession, and we kind of look at different economic indicators. But sometimes there's things that come along that that aren't going to, maybe there's some geopolitical event that's not Ukraine right now or something that people are thinking about that pops up too.
Well, I think one of the things that we've got to think about too, Brent, and as we pop over here, I'm going to pop to my single grid, which is kind of my sandbox that I use for looking at individual stocks and individual names here. I want to look at this /10Y, and this is the 10-year yield futures. Now, I'm using the futures contract here, not as a tradable instrument, not in talking about futures. I do that on Tuesday mornings. But using this as a market measure of evaluating a market. Now, I will say this, if you're going to trade futures, futures are a leveraged product. There is significant risk. Not everyone is approved for trading futures. It's not suitable for all investors, and it requires separate trading authorization. So contact our futures trading desk if you have an interest in doing that. But in this particular case, as we look at the 10-year futures, because there have been a lot of questions coming out, is the Fed intervening in things? Is there going to be a move by the Fed in September? What's going on? I think one of the things that I'm noticing here, Brent, is from a trend perspective, kind of this squeeze that's going on here in yield futures. It's kind of narrowing it down. The momentum is narrowing down. Again, I think this is more kind of indicative of that wait and see mode. Now, the one risk that I want to talk about here, and again, we don't typically tend to get political on this discussion, and I don't want to get political in this discussion. So please, 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 I'm saying this with a lot of trepidation. Please keep the chat focused on the commentary that I'm talking about and not on the political part of this discussion. But one of the reasons that the Federal Reserve works is that it has always been a politically independent entity. It is not a government entity. It is an independent entity administered by and run for the benefit of the banking system. That's its intent. But when that becomes political, that changes the situation. We've seen that volatility occur in the market based on that politicization. Now, we've had some things going on in the last couple of days, some news going on in the last couple of days that bring the political world back into the independence of the Fed. That's a risk, Brent, I think, in this particular case of changing the balance of this system. What do you think?
Certainly that can affect the system. It can affect the markets as a whole. It can affect interest rates as well, and what happens to this 10-year. And one thing I would just always remind people when we talk about the 10-year, the 10-year and the Fed funds rate are very different things.
Right.
And if the Fed funds rate gets cut, it doesn't necessarily mean that the 10-year is going to go down as well. You can see over the past, year pretty much, around that 4.2 level is kind of towards the lower end of where we've been.
For sure.
Let's say we go ahead and we get a rate cut in September, which a lot of people are thinking. I wouldn't expect necessarily that you're going to see the 10-year drop a whole bunch there at that point.
Right.
I could be wrong. I don't know what's going to happen on that. But the 10-year really moves more on a couple things. One is kind of inflation expectations can certainly affect the 10-year. And two, economic forecast or economic strength in the market and expectations in the market can certainly move the 10-year as well. It runs independent of what any specific thing the Fed monetary policy from the Fed is going to do there.
Correct. And so to your point earlier about the Fed having limited input, you look at something like the 2-year. So the Fed can only impact that overnight rate. So they push on the string and then everything else reacts from that. And so you can see that the 2-year in this particular case starting to move down a little bit here in potential anticipation. That's steepening that curve between the shorter term, the front end of the curve, and the back end of the curve, like we were looking at here in this case with the 10Y futures, a little bit steeper than the front end of the curve. And that's a normal expectation, right? That steepening of the curve.
Yes.
There's greater risk further out in time. And if we were to continue that curve out for a longer expectation, you'd see that that curve steepening as you get out to those 30-year rates and so forth, right? But again, I think that's a good illustration, Brent, of the importance of the Fed, but at the same time, the fact that they have a limited influence. But we know that news can, like a rock thrown into a pond, those ripples may get bigger and more influential as they spread out towards the edges of the pond, right?
Yep, absolutely. And it's just hard to predict exactly what they're going to do, which is why often, when you're a trader, say, and that's a lot of our audience here, that's why you need to have a plan in place and manage accordingly. That plan may include stop losses, which don't guarantee an exit at a particular price, but can still be a valuable tool. It may include different asset allocation features. It may include lightening positions at certain times or increasing positions at other times. But thinking about it ahead of time so that when something comes out, you're not reacting based on emotion.
Yeah, exactly. So James asks a great question, and I want to answer this, and then we're going to move to the kind of big thing that we've been talking around this morning. And James asks the question, all other branches of government are answerable to the people. Who does the Fed chair report to for evaluation? Well, they're an independent agency. They're not a government. They're not a branch of government. And I think that's one of the misconceptions that is out there amongst not only professional traders, but also amongst the general public, is that the Fed is a governmental or even a quasi-governmental agency. They're not like Amtrak. They are an independent entity. And so they have obviously some accountability, but in terms of direct accountability or electability and so forth, that is their own deal. And that was by design and the creation of that. Now, we can argue that for years because it's been argued for years, Brent, but that is the way that the system works. So there you go.
Yep.
All right, hey, Brent, NVIDIA. Because everybody's talking NVIDIA, right?
NVIDIA, they're talking for a good reason. And we already mentioned the potential impact on the market. It has been not only a big percentage of these indexes, but it's a big reason why the market, it's been a kind of the forerunner for the market. It's been the driver for the market, NVIDIA and some of the other big stocks. And you can see since April how well it's performed, how much it's gone up. And I think we'd be looking at a very different market if we didn't see that sort of performance on NVIDIA. Now, having said that, if a trend's going to change, probably more often than not, it changes when earnings are going to come out or something like that, and that's more likely to change any technical analysis you do. I'm not saying it's going to. I don't know what it's going to do, but it's been real strong. And something with NVIDIA is, I don't know the numbers exactly, but more often than not, it beats on the top and bottom line in terms of what their actual numbers are. But that doesn't necessarily mean that the reaction is going to go up, Because it's kind of like this. If you're always beating an expectation, then you just kind of expect it to beat the expectation, and then you kind of have this new internal expectation of what's going to happen. And so the market isn't necessarily going to go up, even if we see a beat on top and especially bottom line there.
As Mr. Incredible says, Brent, if everyone's super, then no one is. If every earnings announcement is a beat, then none of them are, right? Because then that becomes the expectation. Now, I posted about this on X yesterday. I posted a quick video. You do those. I know Barb does those. The other coaches post those on X. If you're not following us on X, I'm going to ask you why you're not, because you should be. You can follow Brent on X at Brent Moores CS. You can follow Barb on X at Barb Armstrong CS. You can follow me on X at Ben Watson CS. But one of the things that I talked about yesterday was this on my X video is going to the Analyze tab and the Earnings sub tab, and I put in here NVIDIA, and I'm looking at the past earnings announcements here, and exactly what you were just saying. You see these, so down here in this lower panel, this is the top line, earnings per share expectation. That's the Wall Street expectation. That's the green box and line. And the actual, where that actually comes in. And you can see November, we've got, what is that, August 23. So that was back in 24. You've got November in 24. We've got the February in 24. And so then we keep going into those earnings announcements. You see those beats occurring here, and pretty substantial beats over the expectation. Well, then here's what happens. Wall Street starts to change their expectation. And so now we get just about a meet, and then a little bit of a beat, and a little bit of a beat, and then just a little bit of a miss in this last one. Yeah. And then now here's the future, right? This is this afternoon. So those expectations come back together. Everybody's super. They're really super. They're really super. Now the expectation has changed. Now everybody's super. And we don't know what's going to happen here in this particular case. So you can also see in this view the reaction of the stock to the earnings announcement. So it doesn't always go up on that earnings announcement, even when there is a beat, because we've had beats and it's gone down. So that is a potential risk in this particular case. And to Myron's point, who says that the last earnings in NVIDIA was underwhelming and boring. So, but let's look at where NVIDIA is at the moment in terms of kind of this range. By the way, speaking of range, we've got a feedback survey out there in the chat. Barb's done a good job of reposting that. Do us a favor. This is how we make these sessions better for you. Open that up, set it aside so that you can come back to it, or just wait until after. You run the risk, though, of waiting that we close it down and you don't get back to the link. So click on that link that Barb posted in there, open it up, set it aside, and then you can fill out that feedback survey. It's really just 3 questions and an open field for you to give comments. We'd love to read those comments. They help us to make these sessions better for you. Now, let's pivot back here to NVIDIA. Over the last little while, let's kind of zoom in on this last 2 or 3 month time frame. We've seen NVIDIA kind of oscillating, Brent, between this 173 and about 184. So about an 11-point range up and down within this area. And it, again, the way that I draw levels of support and resistance, as you know, is not too particular, not too precise, kind of oscillates back and forth between these areas. We draw those with big fat magic markers, so not absolute precision. And we're kind of still in the middle of that oscillation, but we're more towards the top side of that oscillation. So I would argue this: if an investor were looking at potential moves for this stock post the earnings announcement, you could probably look to this range in the very near term as a kind of an extension of that. What do you think?
Yeah, you can certainly use, just as kind of saying before, you can use technical analysis here, and what you can and use those as kind of maybe guide rails. Now, let's say we have a really positive reaction on NVIDIA. We're a little bit closer to that upper guardrail, so to speak. We're probably more
Yes.
likely to break out of that one, Ben, than we are on the downside. And
Yep.
I don't know what's going to happen. Now, one thing you can do is you can look for like a market maker move as well on the Thinkorswim platform to try and get some idea of what the market is pricing in. Of course, the market doesn't know for sure, but you can see about 11.5 point move. You pointed to right there in that yellow.
Gosh, that's pretty darn close to the range of that channel, isn't it, Brent?
Yeah, that is pretty close to the range of that channel. So, and the things can surprise us, but it certainly wouldn't surprise me, especially on the downside, if we got down right around where that old support level is.
For sure. Now, let me explain really quickly this market maker move. And I know we have a bunch of videos. I know you've talked about it, Brent, in your options classes. I've talked about it in Your First Trade, which is the show that I host, and you've been a contributor, as has Barb, on the Schwab Network. Schwab Network brought to us by our media affiliate, Charles Schwab Media Productions, separate but affiliated company. But we've talked about what creates this market maker move. And this market maker move is the market's expectation given a particular event. And this occurs. We get this market maker move, and that expected plus or minus dollar move in the price of the stock based on a specific event. When there is a disparity, when front month volatility of the closest option expiration is higher than the next available expiration, that's when you'll get a market maker move trigger there. That's when you'll see that flag. Then to calculate that number, it's a proprietary calculation based on probability, based on the Black-Scholes calculation, based on implied volatility. But that is the assumption of what the market is expecting, what the options market is expecting the stock to do. Now, not talking about trading options again. Remember, if you're going to trade options, make sure you understand the characteristics and risks of standardized options before considering those strategies. But I wanted to use this as an available piece of information about the potential move for the stock, because that's where the market is expecting that range to move. So if I were to do this, if I were to just take that distance right here, Brent, I'm just going to draw my line right there. That's about 12 points or 11 points or so. I'm going to right click, I'm going to duplicate that, and I'm going to stick it right up here on top. I'm actually going to stick it kind of right about where the price of that stock is at the moment, right about that 180 mark. And we know where the bottom side is. It's down here right around 171 or so. So we might be looking at a range of movement here, 192 down to about that 171, 172 range or so, where we might see this price oscillate. Now, that's not a guarantee by any means. That's just simply, again, kind of extending where those navigational buoys might be that might be suggested by implied volatility and what the options market is saying, right?
Yeah, and just one other point I would add here. Sometimes people will look after hours at the movement after hours, after earnings comes out, to try and know. But I would just caution people a little bit. I look at after hours charts quite often, and very often things can drastically change between what the initial reaction is and what later reactions are on the chart. So we'll see, very likely we may see a gap tomorrow up or down on NVIDIA, but it can be a kind of an interesting experience for those of you who haven't watched something on earnings before. When they release, you just need to go to an intraday chart and make sure your intraday data is showing on that to watch
for sure
after hours.
Absolutely, and that's a great way to look at it. Now, Bill asks the question: what's the time frame of that market maker move? And the time frame on that market maker move is, my understanding, Brent, maybe that is within the range of this expectation here, this next option expiration. So that's going to be 2 days. So that would be the end of the week. That would be Friday. So that makes sense in terms of that move. And then you start to get into those individual expirations and their expected moves. And again, same proprietary calculation. But the reason this gets triggered as a market maker move is when you have that disparity between closest expiration and next available expiration. That difference in implied volatility then triggers that market maker move calculation. So it's a short-term expectation, not a longer-term expectation. And remember, that's a discrete point because then everything changes, right? Because now the market is behaving in response to the information that was put out on the earnings announcement. So that's just simply a guideline, never a recommendation and never a guarantee that the price is going to move that far. Neither is, I know this is something that Barb looks at quite a bit, and I'm going to just do this. This is ATR, average true range. This is, again, a volatility-based assessment of how far the stock moves on a daily basis based on in this case, 14-day look back.
Yeah.
And you can see where that ATR has gone to, about $4 or $5 on a daily basis. It can increase, it can decrease, but that's another way to maybe look at this, X that information about the earnings announcement, right?
Yeah. One thing I would add on that ATR, that's a backward looking measure of the market and of the whatever we're looking at here. In this case, it's NVIDIA. Whereas the market maker move is taking into account implied volatilities, which are more forward-looking as to what expectations are. It's kind of akin to the difference between historical and implied volatilities. There's a difference there on those, and so that's what you can see. And by the way, if you are interested in those historical volatilities, you can see those on that same chart that Ben was showing you earlier, where on the earnings charts there, where it went quarter by quarter on the earnings, you can see that volatility column there that has implied and historical volatility. Right. And so if you look, you can compare the old historical volatility of how much it's moved after the move. So it's kind of hard to see, but there's the move. Ben's cursor's right on that when that move is. And then you can look and see what's happened to the historical volatility in yellow. And that was an interesting one you're pointing out right there, because it didn't really go up at all. Typically, you'd expect it to go up, the historical volatility, but you'd expect the implied volatility to go down on the release of earnings because there's less uncertainty at that point.
Right, so, for sure.
Yeah, another way to look at it.
And that's exactly, so you can see where we are right now. Here's where the current situation is. Implied volatility is relatively high. Historical volatility relatively low. About half of that implied volatility, and that's not, again, I'm going to caution that does not suggest, because implied volatility is high and historical volatility is low, that does not suggest, nor does it guarantee, that price is going to move any more or any less than it has at other circumstances when those two are separate from one another. Sometimes they are right on, because at this is the February earnings announcement. They were right about the same level at the announcement, and then they moved in disparate ways. So the fact that they are wide apart here just suggests that I think that there's some speculation going on in both directions at this particular point. And speaking to the idea of why this is widely looked at now as kind of that bellwether, again, because of that weighting component. But Brent, I wanted to mention before we go, because we've just got a couple of minutes left here, I wanted to talk about two things, and I mentioned this earlier, that halo effect. We've oftentimes talked about the halo surrounding Apple and the manufacturing components that go into this. So there's, again, some additional volatility if we take a look at AMD, which is a major competitor to NVIDIA. They are racing to close the production gap for sure. And you can see that investors have pivoted to that direction. But there's a couple of other things. We take a look at INTC, Intel, which has now undergone an interesting transformation. 10% is owned by the US government. And so they are one of the few companies, one of the few foundries that actually does their own manufacturing. So they avoid some of the bottlenecks in production that perhaps NVIDIA and AMD may run into. And you can see that they've had a strong run since that change has occurred. Their historical, or ATR, has increased as well. RSI a little bit stronger, again, kind of in a wait and see mode. But Brent, two more stocks that I want to look at here really quickly. Both AMD and NVIDIA rely on TSM, Taiwan Semiconductor, and you can see how Taiwan Semiconductor is kind of echoing the same pattern that both AMD and NVIDIA are following here. So it's likely that if NVIDIA moves, AMD is going to move, as will TSM. Not a guarantee by any means, but there's another one. If you go even further back in the supply chain, ASML, which is, again, this is an ADR as well. Remember, ADRs, American Depository Receipts, may be subject to other markets' influences. That's why you see these gaps. So be aware of that when you're trading an ADR. But these guys build the manufacturing machinery that TSM, Intel, and others use to make the chips. So we're going back in the supply chain. So you may see a change here in ASML based on movement in the in NVIDIA. So wag the dog here, Brent.
That'll be interesting to look at, Ben. I know we're just about out of time here, but
Yeah, for sure.
I appreciate that. And so everybody, keep an eye on NVIDIA tonight.
Remember, there's that feedback survey. Fill out that feedback survey. If you want more information, check out our Trader Talks webcast channel. Click on subscribe. Give us a follow there. We'd love to have you there with us. Brent, thanks. It's been so great having you here with us. Brent, Barb out there in the chat, and all of you, great conversation today. I loved it. And we will see you guys again very soon. I'll be back trading index options here in a little over an hour. We'll see you then. Take care. Bye-bye.